We have already talked about the concept of the tax base, but in this section we will get into a little more details. We will talk about determining the tax base of an asset, a liability, and then we will look at the impact of changes in tax rates. Here is another definition of the asset tax base from the curriculum. The asset tax base is the amount that will be deductible for tax purposes in future periods as the economic benefits become realized. But I think from a testability perspective, it is important to understand how to come up with the carrying amount and tax base and hence the difference. I want you to pause the video and complete this table before looking at the answers. Here is what you should come up with. The capitalized development cost is equal to 100 at the start of the year. During the year, 30 was amortized, which means that on the financial reporting side, we have a carrying amount of 70 at the end of the year versus a tax base of 75, because for tax purposes, only 25% amortization is allowed. The temporary difference is 70 minus 75, which is minus 5. The rest of the numbers are fairly obvious. Determining the tax base of a liability. The tax base of a liability is the carrying amount of the liability less any amounts that will be deductible for tax purposes in the future. Again, let us understand this through a typical example. Customer payments received in advance equals 50. This amount is taxable. You've seen this several times, but just to reinforce the concept. So let's say we are talking about period 1. The amount received in advance is 50. The service or the product will be delivered next year. On the tax side, this 50 is taxable, but on the accounting side, we need to create a liability called unearned revenue. So the carrying amount of the liability is 50. That's why you notice that the carrying amount is 50 and this is a liability. On the tax side, we have paid taxes, we have recognized or shown the 50 as revenue. So the tax base is 0. The temporary difference is 50 minus 0, which is 50. Changes in income tax rates. The measurement of deferred tax assets and liabilities is based on current tax law. If there is a subsequent change in tax law or new income tax rates, then existing deferred tax assets or liabilities must be adjusted for these changes. The concept here is fairly straightforward. If we have a deferred tax liability which is equal to 6 based on this formula, the tax rate we are using is 40%. What happens if the tax rate is reduced to 30%? Essentially then, rather than multiplying by 0.4, we will multiply by 0.3. So we will get 4.5. So here is the relationship that you need to recognize. A decrease in tax rate reduces the deferred tax liabilities and it also reduces deferred tax assets. The example that we just did illustrated deferred tax liabilities. With deferred tax assets, the way you can think of it is as follows. You have a deferred tax asset if, for example, the carrying amount is less than the tax base. If we have a carrying amount which is equal to 25 and a tax base which is equal to 40, then essentially you will have the following: 25 minus 40 into 0.4. This gives a minus number. A minus number would mean that we have a deferred tax asset. If we multiply instead by 0.3, which is the lower tax rate, then in absolute terms we will have a smaller number. That is the mathematical way of looking at it. The business way of looking at it is that you have a certain deferred tax asset based on a 40% rate. If the rate comes down to 30%, then that will reduce the value of the asset. So in any case, you need to remember this. If the tax rate comes down, then both deferred tax liabilities and deferred tax assets come down. On the other hand, if tax rates increase, then both deferred tax liabilities and deferred tax assets go up. Try to do this example now, and I'll just clarify one point. When we say something benefits the income statement, that means that the income, or the net income to be more specific, is better. When something benefits the balance sheet, that means equity is more. Here is what you should come up with. We have a decrease in the statutory tax rate. The statutory tax rate is the rate announced by the government. What this means is, for a company which has a net deferred tax liability, this net deferred tax liability means that if a company has both deferred tax liabilities and deferred tax assets, then the difference between the two is a net deferred tax liability. And if this number is positive, or the company has a net deferred tax liability, then obviously overall the deferred tax liabilities are more than the deferred tax assets. So simplistically, we can say that a company has a deferred tax liability. Let's say that the deferred tax liability is 10. If the tax rate comes down, then obviously the taxes are lower and the net income is higher, so that benefits the income statement. What about the balance sheet? When we have a lower tax rate, then this net deferred tax liability comes down. The asset is not impacted, or assets in general are not impacted. Obviously the deferred tax asset also comes down, but we have bundled the deferred tax assets and liabilities into this net deferred tax liability. All other assets are not impacted. Since the deferred tax liability, or the net deferred tax liability, is coming down, that means that the equity is going up, which again means that the balance sheet is becoming better. So a decrease in the statutory rate benefits both the income statement and the balance sheet. Temporary and permanent differences. Permanent differences are differences between tax and financial reporting of revenue or expenses that will not be reversed at some future date. These differences do not give rise to deferred tax liabilities and deferred tax assets. Some examples are as follows. If we have income or expense items that are not allowed by tax legislation, so there might be some perks that a company offers senior management, where those perks are shown as expenses on the income statement, but they are not allowed, or they are not tax deductible in terms of the tax rules. That will create a permanent difference between the tax income and the accounting income. Another example is tax credits for some expenditures that directly reduce taxes. This word directly is important. If you have a tax credit that is directly reducing taxes, then that creates a permanent difference. This is not to be confused with something you will see later, where the impact is not direct. When we have permanent differences between tax and financial reporting of income, then the effective tax rate will be different from the statutory tax rate. And we can then calculate what is called the reported effective tax rate. To come up with the effective tax rate, we only look at the income statement. So this is from our financial reports. We look at the income tax expense from our income statement and divide by the pre-tax income from the income statement to come up with the effective tax rate. Do this example now. If you followed what I just said, then you will notice that I have given you 4 numbers. 2 from the financial reports. So income tax was 20 against earnings before tax of 100. The tax payable was 25, taxable income was 110. These are the 2 numbers we need to use. These numbers we do not use when coming up with the effective tax rate. So our effective tax rate is 20 over 100, which is 20%. Examples of temporary differences. Temporary differences between taxable and accounting profit arise from a difference between the tax base and the carrying amount of assets and liabilities. Deferred tax liabilities and deferred tax assets are only created if there is a temporary difference which is expected to reverse in the future. Let us look at a few scenarios. We have a balance sheet item which is an asset. If the carrying amount of the asset is greater than the tax base, then we create a deferred tax liability. And this is the classic example that we've seen before. If we do straight line depreciation for accounting purposes, then this depreciation number is small compared to the depreciation we have with accelerated depreciation, which means that the carrying amount is going to be greater than the tax base. And as we have seen several times, that creates a deferred tax liability. Again, with assets, if the carrying amount is less than the tax base, then we create a deferred tax asset. And we've also seen this example where the research cost is expensed, so the carrying amount there was 0. Whereas on the tax side, the cost is spread over multiple years. That would mean that on the tax side, we do have some value for the asset. 0 is less than that value, which means that we create a deferred tax asset. Coming now to liabilities, if the carrying amount of a liability is greater than the tax base, then we create a deferred tax asset. And we've also seen this example where cash from customers is received before the revenue is recognized. On the balance sheet, we will create a liability called unearned revenue, and that is going to be greater than the amount on the tax base. If the money received is taxed, then no liability is created on the tax side, so we have a 0 over here. Unearned revenue, or the carrying amount, is greater than the amount or the tax base, and we therefore have a deferred tax asset. If we have a liability where the carrying amount is less than the tax base, then we have a deferred tax liability. I cannot think of a good example, and I could not find a good example in the curriculum either, so I don't think this is too important. As long as you understand these points and just memorize these relationships, you are in good shape. Just in terms of a trick to memorize, you can remember this first item because this is something you've done over and over, and then everything else just follows. Carrying amount greater than tax base creates a deferred tax liability. If you have an asset and the carrying amount is less, then obviously you will have the opposite, which is a deferred tax asset. The liability will again be the opposite for the asset, assuming that the carrying amount is greater than the tax base. So here you had a deferred tax liability. Here you have a deferred tax asset. Coming now to unused tax losses and tax credits. Tax loss carry forward occurs when a company experiences a loss in a current period that may be used to reduce future taxable income. So if you have this situation where in period 1 a company incurs a loss, obviously the company will not pay any taxes over here, but under some rules it might be possible that because of this loss the tax in the next period will be lower. When this can happen, we say that we have a tax loss carry forward, and this is essentially unused tax losses. So these two terms are related. The one that you really need to memorize is tax loss carry forward. Tax credits reduce the actual amount of tax owed. Governments may grant a tax credit to promote a specific behavior. So a company might set up a factory in a rural area because the company gives a tax credit for doing so. IFRS allows recognition of unused tax losses and tax credits only to the extent that it is probable that in the future there will be taxable income against which the unused tax losses and credits can be applied. What this means is the following. If you say you have a tax loss carry forward, that is only useful if you will have a profit in the subsequent periods. If it is unlikely that there will be a profit in the subsequent periods, then it doesn't make sense to recognize this tax loss carry forward. And to make this more specific, let's say that tax rules say that the tax loss carry forward can only be used up to this point in time. So we need to figure out whether there will be profitability in those periods so that we benefit from this tax loss carry forward. If we do not expect any profitability here, then it doesn't make sense to recognize the tax loss carry forward or the tax credits. Under US GAAP, a deferred tax asset is recognized in full, but is reduced by a valuation allowance if it is unlikely that the benefit will be realized. So essentially, because of tax loss carry forwards or tax credits, we can create a deferred tax asset, and if necessary, according to US GAAP, this amount can be reduced using a valuation allowance, and we will talk about this later. As you have probably gathered, we need to assess whether we will have profits in the future so as to determine whether or not we can recognize our tax loss carry forwards or tax credits. In other words, we need to know whether those tax loss carry forwards and tax credits are going to give us any benefit. And I'm not going to read this, but you can. Here are some general guidelines when assessing the probability that sufficient taxable profit will be generated in the future. Do this question now. Here is what you need to note. So Acme incurs an expenditure which results in a tax credit. This tax credit directly reduces taxes. What is Acme likely to do? The correct answer is no deferred tax asset or liability. And this is a trick question, and I am doing this with you so that you do not fall for this on the actual exam. The key word here is directly reduces taxes. And if you recall from an earlier slide, if you have a tax credit that directly reduces taxes, this results in a permanent difference. When you have a permanent difference between accounting profit and taxable income, then we do not create deferred tax assets or liabilities. What we have been talking about on the previous slides is situations where the tax credit or tax loss carry forward does not have a direct impact on taxes. Now, what we are talking about on the previous slide is a tax credit or tax loss carry forward that will benefit us in the future if we do have profitability. So from an exam perspective, watch out for this term. When we have tax credit directly reducing taxes, then we do not create a deferred tax asset or liability. If we do not have this word direct, then a tax credit might create a deferred tax asset as long as it is probable that this tax credit will give us some benefit.